the episode today we're talking about is managing through predictable or seasonal slowdowns, which is absolutely a thing in the trade show and event space. So
Yeah.
I think particularly small and mid-sized companies, you're guaranteed to experience this. Larger companies, I'm not saying you don't see swings, but you've got the capital reserves, you've got, maybe a broader lines of credit. You have other tools and resources you can use to get through those. But I think for this conversation, I think it's going to be most helpful for that small and
Yeah.
mid-sized business leader. So
So what for you, Chris, what are the things that you start to see in these months? What is typical?
yeah,
Maybe
great.
it's currently for QXP, maybe it's been in the past, but what are the things that you notice during this time of year that are the signs that, yep, we are
Yeah.
slowing down?
So we'll see financial pressures from multiple areas of the business start to show up. For example, um, our vendors may be more frequently contacting us for payments that normally they might let slide without a phone call for a month or two. And we're not those guys anymore, but I remember, starting out, if you weren't calling me, we just thought everything was okay. But you can get yourself into trouble if it's 90 days and you haven't made a payment to a vendor. Clients may start paying you at a slower rate. Our friend of the show, Michael McMahon, has been on a few times. I love his philosophy with vendors. He says, we like to pay them early and often. And I go, oh, does that include summers? Right? It's slow down time. But it is for him. You might, let's say you bought a building and you have a line of credit is active. You may start hearing from your banker more frequently. Just checking in. It's just that subtle pressure that he's seeing deposits down and a change in your cash pattern with your business. So he might be checking in some cases with things like if you bought a building or built a building, there's covenants where you have to report your financials every quarter. I used to cringe at those quarters where I knew we just were not looking our financially at our best. I think you see your AR report, your accounts receivable report starts to drop. Man, I love my current AR stuff because if we're at $1 million or $2 million and it's current, that's money in the bank. That's really your receivables are what you're really going to be living off of for the next 90 days, right? So it's a healthy sign of your business. We know that's going to go down that number because we're going to be using that and we're not building that back up. So that's another thing. So and inevitably negative cash flow is as simple as add up what you collected this month and add up what went out on all your fixed costs. And when you're upside down, that's your negative cash flowing. And we really don't want to see that more than 1 or 2 months in the summer. If you my experience has been if that goes into a third month of negative cash flow, man, it could take us. There's no bouncing back quickly because now you've got that catch up stuff, right? That you have to worry about. It could take us if that happens if summer runs not 6 weeks, but summer slowdown runs 12 weeks. It takes us the rest of it. There are days it took years. It took us the rest of the year to get back to being, the healthy company. So thankfully, we're not that anymore. But you made a great point about it's predictable. You should be thinking about this. That part of our playbook every year is, um, one of the things that we instruct our controller to do is whatever collections come in, payments that are sent automatically or just we're tickling them with invoices at AR calls. 10% of that is set aside in our it's just called the savings account, but it's the capital reserve account. Um, we do that all year, and I will say, in the first 6 months of the year, by the time June's ending, and we may be facing our first, slowdown month of July, um, she's put away, she's got reserved enough money that we could pay the bills for 3 months, right? And so
Mm.
we're never zero. We just have to augment that. But we're not going out to a line of credit, and we're not going out on credit cards, and people have done that. And God help you if you're that company, and I know what it looks like to get the American Express loan. It's 12 months, and it's based on your credit card processes, and you're going to pay some crazy amount of money, like 18 or 20%, to borrow $500,000. So what's 18% of 500,000? Think about that. And it has to be
Yeah.
paid back within a year. And they're doing it based on what your historic credit card fees are. So if you're a company that gets a lot of payments on credit cards, it's a significant amount of money they're willing to loan you, but you never get more than a year, and it's it's like a credit card at 20+%. That's not a good
Yeah.
plan. So
It's not.
it's better to live within your means. So to your point, in those months, Khalil, we're looking to we've got to cut our expenses, and we have some very predictable things that we do, and we can share those. Or you want to increase your sales, but when there's only 10% of the shows happening for a quarter for the whole year, you're now looking for other type of work, and everybody in our industry knows what that looks like. My recommendation is that it be something that's complementary to what you do. In a few words, it allows you to use the infrastructure that you already have and not have to and support the people that you already have rather than go out. The pandemic was horrible because right everybody wanted to make masks, or we were making acrylic sneeze guard sheets, or we were I know one part of ours was making a school new desks for elementary schools that had acrylic protectives between them. That we never found a thing that we could pivot to because it just wasn't what we were doing, and we weren't going to go out and spend money to do something temporarily. We didn't know how long that would last. So, but we have gotten into some permanent install work with museums, I remember so a couple summers ago, we had 34 banks that were being remodeled, and they needed us to come in after hours. And we could turn 2 banks in one night at branches with the new remodel of what they were doing. So that was a good fit for us. So I think we all look for things like that in the summer slowdown. But the things I can say that I was typically seeing to reduce our costs. We have summer hours for shop and field personnel. You're only going to get 30 hours. If you're normally a 40-hour person, you're down to 30 hours. We are encouraging all employees, and we do it all year, to schedule your vacation time or your PTO time during those quieter months. It helps everybody. And by then, after a robust first 6 months, they like that. Everybody's ready for some vacation time. I don't want you calling and taking the vacation time in October when we're back in the high season. We need you. So that's a dance you perfect over time with your
Yeah.
with your hourly staff, but we did. I think again, when we've been able to save some money, so we will plan refurbishment of inventory or facility projects. Right now, our Las Vegas facility, we are taking about a 600 square foot area in the front, and we're creating a kind of a lounge lobby area for people that come in. And it could be another meeting space for us, but we will also any of the 200 some odd laminated counters we have that need to be relaminated, or there's chips, or same thing, lighting gets tested. We do inventory. We're going to be paying people. I want to make sure um, that everybody's got more than what unemployment would give you, because we don't want people leaving, because it's hard to get them
Yeah.
back. If they go